Hello, and welcome to Lease Queries Accountant's Angle, a podcast where our experts answer your most burning questions regarding accounting topics and upcoming changes. I'm your host, Emily Fish, Product Accounting Manager here at Lease Query. And today I'm joined by Sarah O'Sullivan, Director of Product Accounting at Lease Query. We'll be discussing the newest lease accounting standard that is applicable to the federal government level, SFAS 54. Sarah, thanks for joining us. Let's get started. Lease accounting seems to be the gift that keeps on giving. Am I right? I've heard that there's now a new standard for federal agencies. Is that correct?
Hey, Emily. Yes, that's correct. There's another one coming down the road. So federal accounting is governed by standards set by what's called the Federal Accounting Standards Advisory Board, or FASB for short. So it is a separate jurisdiction and separate standard setter from FASB and GASB. But similar to its FASB and GASB counterparts, the FASB has also issued a new standard for lease accounting that's going to represent a really significant change for federal agencies. So this new standard, SFAS 54, is effective for federal entities for fiscal years beginning after September 30th, 2023, and early adoption is not permitted. So that means the effective date for this new standard, it's about a year away now.
All right, so we need to start getting ready. Is it similar to the state and local government standard, GASB 87, that we're familiar with? And how is it different?
Yeah, so SFAS 54 is pretty similar to GASB 87 in a lot of respects. And GASB 87, again, as a reminder, it's the required lease accounting standard for state and local governments. So the FASB, the board itself and its staff, they consulted with the GASB and they used GASB 87 as a model to help them when they started their own journey to their new lease accounting standard. So similar to the new GASB rules, the new federal accounting standard does utilize a single lease classification model. So whereas previously they were operating in capital leases, now all leases going forward that are within scope will be classified as finance leases. The most significant impact, again, from the federal standard is similar to what preparers under FASB and GASB have already been experiencing, and that is the capitalization on the balance sheet of a majority of their leases, which previously they were accounting for them as off balance sheet leases when they were operating leases. And so now they're going to have to pull them up as assets and liabilities on the balance sheet. So SFAS 54, it does require entities to record the lease liability to represent the present value of the remaining lease payments and a corresponding asset that represents its right to use that underlying fixed asset that they're leasing. The methodology, the calculations for initial measurement and subsequent accounting of those lease balances, they're relatively consistent between the GASB and federal standards. So if you were to look at it line by line, you'll see a lot of similarities. But however, federal accounting and reporting environment, it does have some unique characteristics and needs. And so there are some differences that we could highlight between SFAS 54 and GASB 87. And I would say the two really biggest differences that you'll see between the standards are their short-term scoping criteria and the way that the federal standard requires accounting for what's called intergovernmental leases. So that first one that I mentioned, the short-term scoping criteria. So similar to GASB 87, the federal standard, it does allow preparers to scope out leases that are considered short-term. The difference is that GASB 87 short-term scope criteria is 12 months. Under SFAS 54 for federal accounting, that short-term criteria is 24 months. So it's 2 years actually, but that is consistent with how federal accounting currently requires their policies for capitalizing fixed assets as well. So it's the same kind of accounting. If it's short-term, you're not going to capitalize it on the balance sheet, no asset, no liability. You'll continue, federal agencies will just, they'll record their expense, their rent expense for these short-term leases as they are making their payments. It's based on their payment arrangements, and any adjustments that they might have, things like increases in the payments, if they get incentives, they get concessions or money off, free periods, all of those are going to actually be recognized in the period when they incur. So they do not need for these short-term to do straight line expense accounting. But the big difference obviously is 24 months is your scope threshold as opposed to 12. And then that second item that we mentioned, it relates to intergovernmental leases. So the federal reporting environment is unique in the aspect that there are quite a few federal agencies or sub-agencies, and the various agencies, while they report, many of them report their own individual financial reports, they ultimately are all consolidated together and included in the total US federal government's annual financial report. And so in a federal space, it's common actually for federal agencies to lease assets between each other. And that's what we mean when the standard says intragovernmental leases. It's when the agencies are leasing between each other. And so at that consolidated reporting level, at that top level, the US federal government overall, these intragovernmental leases, they need to be eliminated, the impacts. It's really similar to how, companies account for intercompany transactions within their different business units or segments. And so the federal standard, it went ahead and the board decided to scope out intragovernmental leases from the new requirements. And that decision was made to help make the accounting and reporting process more efficient for each of these individual agencies that are involved. So since if they were to record the lease liability and the asset balances for these intragovernmental leases, they're ultimately going to need to eliminate and adjust them off for consolidated reporting purposes. So the staff and the board wrote the standard so that they don't even need to record the assets and liabilities to begin with. So those are the really big ones that stand out as the differences, but otherwise there is a lot of similarity.
Well, thanks so much, Sarah, for this initial overview of SFAS 54, and thanks to our listeners for joining today's Accountant's Angle. Stay tuned for the second part of our SFAS 54 discussion, and don't forget to subscribe so you get new episodes straight to your inbox.